Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Glad to be here.
We've got quite a stack of articles in front of us today looking at everything from global markets, those trade talks, obviously,
Big topic.
corporate news, some pretty serious privacy issues, and even crypto, pulled from outlets like, CNBC, MarketWatch, Bloomberg.
Usual suspects.
Exactly. And our mission, like always with the deep dive, is really to cut through all that noise. We want to pull out the key insights, the important facts.
The stuff you actually need to know.
Right, give you that shortcut to being really informed on what's actually moving the financial world today.
Okay, so let's unpack this.
Right. And the biggest driver, it seems, dominating headlines pretty much everywhere we looked, CNBC, Asia, Yahoo Finance, Bloomberg, it's those ongoing U.S.-China trade talks.
Day 2, happening in London now.
Yep, day 2. And the market is just kind of hanging on every word, or maybe the lack of words coming out so far. Yeah, exactly. The CNBC Asia Live blog confirmed the key players. You've got U.S. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and Trade Rep Jameson Greer meeting with China's Vice Premier He Lifeng. It's a serious delegation.
It really signals this is important. And the sources, they give us a bit of a peek into what's actually on the table.
What are they saying?
Well, from the U.S. side, a major focus highlighted in CNBC Daily Open and Yahoo Finance seems to be pushing China to relax those export curbs on rare earths.
Ah, the critical minerals.
Exactly. Vital for everything from EVs to defense tech. China's control there is, well, it's significant leverage, isn't it?
No kidding. Meanwhile, China, according to Bloomberg and CNBC Daily Open, they're looking for reciprocity. Makes sense.
Totally. They're apparently bristling a bit at the U.S. grip on things like chip design software exports.
Yeah.
That's a real sore spot for their tech ambitions.
And they want the U.S. to revoke what they call, negative measures. So it's complex, definitely not one-sided.
Not at all. And President Trump's comments have also been making headlines across these outlets.
What's he saying?
Well, he's saying talks are going well. He's only getting good reports. But then he adds that China's not easy.
Huh, yeah. That sounds about right. Guarded optimism, maybe?
Sort of mirrors the market's reaction, I think.
Yeah.
Which has been, well, pretty mixed globally as investors just wait for actual details from London.
Right. The CNBC Asia Live blog pointed that out. Some indices up, others flat or down, especially looking across Asia.
But one interesting movement tied to the talks is oil prices. Brent's holding above 67 talkers, WTI, around $65.44. They're extending gains.
And the thinking there is progress in talks eases demand fears.
That seems to be the hope, yeah. Easing fears about a global slowdown. On the other hand, Asian currencies, mostly weakening against the dollar. The USD index ticked up a bit.
Okay, so with that trade talk backdrop, let's maybe zoom in quickly on how Asia-Pacific markets actually did today, Juneteenth. What did the numbers show?
Sure. Looking at CNBC Asia's reporting, Japan's Nikkei finished up slightly, but the topics was basically flat.
Okay.
South Korea, though, had a pretty strong day. The Kospi actually extended its winning streak. That's 5 sessions of gains now.
Wow. Impressive run.
Yeah, and analysts like Macquarie Group, cited in CNBC Asia, are even talking about a potential bull market rally there. They're linking it partly to expectations of expansionary government spending.
Interesting. What about China?
Well, mainland China's CSI 300, it actually flipped to a loss by the close. Bloomberg noted that was quite a sudden shift.
And Hong Kong?
Choppy and flat for the Hang Seng Index itself, but the Hang Seng Tech Index took a notable plunge, down over 1%.
Ouch. So tech weakness there.
Definitely.
Yeah.
But contrast that with Australia. The S&P 200 actually hit a record high today.
Really? What led that?
Mostly gains in banking and energy stocks, according to the reports. And Taiwan also saw a solid surge, hitting a 2-month high. Driven mainly by its big tech sector, names like TSMC saw good gains.
So definite divergence across the region then. Strength in places like Australia, Taiwan, maybe specific sector stories there.
Seems likely. Versus that weakness in China and Hong Kong tech, which, yeah, some reports are linking back to those trade talk jitters or maybe broader sector concerns.
Right. CNBC Asia pointed out declines in big names like Meituan, Semiconductor Manufacturing International.
Yeah, those took hits.
Yeah.
And specific local factors play a role too. We saw some big losses in South Korean retail stocks. Lotte Shopping, E-Mart.
What was driving that?
CNBC Asia reported it was concerns over a proposed bill. Apparently, it would mandate store closures for these big chains on public holidays. Just shows how local news can really hit specific sectors hard.
Absolutely. Okay, let's shift gears and look over at the U.S. market picture. How did things look overnight?
Pretty quiet, actually. Monday was muted. CNBC, MarketWatch, Yahoo Finance all noted that. The S&P 500, NASDAQ, Dow really didn't move much at all.
And futures this morning.
Also, just kind of treading water in early Asian hours. We fell slightly, maybe, but nothing dramatic.
Okay, but you mentioned something interesting earlier about the sentiment.
Yes, this is where it gets really interesting. While Monday itself was quiet, the feeling among some analysts right now seems, well, increasingly bullish, particularly for the S&P 500.
How so?
Reports from the J.P. Morgan trading desk, cited in CNBC Daily Open, are suggesting that, if these U.S.-China talks go well, that could be the catalyst. The push needed to get the S&P 500 over the line to a new peak. It's only about 2% off its recent high right now.
Wow, okay, so they see that as a real possibility.
And it's not just them. Yahoo Finance did a bull case analysis piece, points to a growing number of strategists boosting their year-end S&P 500 targets. Some are looking at 6,300, even 6,500 now.
And the logic there is less tariff risk.
That seems to be the core belief, yeah, that maybe the worst-case tariff scenarios are off the table now, removing a huge cloud of uncertainty. Citi, for example, just bumped their year-end target up to 6,300.
It's not everyone singing that tune, is it?
No, definitely not unanimous. Morgan Stanley also mentioned in that Yahoo Finance report they're still more cautious. They see limited upside.
Why is that?
They argue rising bond yields tend to depress stock valuations. Even if, a moderate economic slowdown is already priced in, those higher yields are a headwind.
Right, the valuation argument.
Exactly. And adding another layer, MarketWatch had a piece on big money, referencing State Street data. It shows institutional investors, the really big players, are only now starting to really embrace this rally.
So they were late to the party.
Seems like it. DataTrek Research sees this as potential fuel for a melt-up into the end of the quarter.
Okay.
But they also warn that these risk appetites, the levels they're reaching, are historically consistent with the near-term market top. So a bit of a double-edged sword there.
So for your portfolio, listening out there, what do you make of this? You've got top strategists calling for big gains, maybe a melt-up.
But others are cautious, pointing to valuations, yields.
And the big money is finally jumping in, but maybe right when things are getting frothy. It's a really nuanced environment, isn't it?
It absolutely is. Needs careful navigation. Okay, moving on to some specific company news making headlines. Apple's WWDC, their big developer conference, happened yesterday.
Right. What came out of that?
CNBC reports they announced some significant software changes. A redesign for iOS called Liquid Glass. Sounds fancy.
Liquid Glass. Okay. But the market reaction wasn't great.
No. As Yahoo Finance and CNBC pointed out, it seems there was a lack of major AI reveals. And that's what Wall Street is really, really looking for from Apple right now.
So investors were underwhelmed.
Reportedly, yeah. Sent shares down about 1.2% on Monday. The market just wants proof Apple can really compete in this AI race.
Makes sense. Any winners?
Well, Boeing is apparently back on momentum screens, according to CNBC Stories today. Shares were up over 3% Monday, hit a new high. It's had a strong run these last 3 months.
And their May deliveries report is due today, right? That's always key.
Always closely watched, yeah. And then there's Microsoft. Just keeps climbing.
Unstoppable, it seems.
Pretty much. CNBC reported it hit another all-time high on Monday. Still the world's most valuable company. Some chart analysts are even pointing to a potential golden cross formation.
Ah, the technical signal. Short-term average crosses above the long-term.
Exactly. Some traders see that as bullish, confirming the uptrend.
Okay. But not all sunshine and roses in corporate land, I assume.
No, McDonald's got downgraded. Both Morgan Stanley and Loop Capital.
Oh, why is that?
As CNBC reports, the analysts think the stock looks expensive, trading around 25 times earnings. And they believe it's not immune to the wider concerns bubbling up in the fast food industry. Shares dipped slightly on Monday.
Although, I saw Jim Cramer push back on that.
He did, also on CNBC. Called McDonald's the king, good value, well run. So yeah, clear difference of opinion there among the analysts.
Always good to see both sides. Now, you mentioned Asian retail investors earlier.
Yeah, an interesting insight from Bloomberg's coverage. Remember back in April when trade tensions flared up and U.S. stocks dipped?
Vaguely, yeah.
Well, Asian retail investors were apparently aggressive buy-the-dip buyers then. Really jumped in.
But that's changed.
That Bloomberg article noted that by May, as the S&P 500 rally kind of slowed down, they started pulling back. South Koreans sold over $1 billion in U.S. stocks. Japanese investors offloaded quite a bit of U.S.-focused ETFs.
Interesting. So their enthusiasm cooled a bit.
It seems so. But what's telling, though, is the article suggests that despite this recent pullback, these investors generally still see U.S. stocks as, like, a safe, reliable, long-term bet. Speaks volumes about the global perception of U.S. markets, I think.
Yeah, that's a good point. And this kind of buying and selling, it connects to another market phenomenon MarketWatch was discussing, right, in the context of Robinhood.
Exactly. The whole buy the rumor, sell the news idea, specifically around stocks getting added to big indices like the S&P 500.
What happened with Robinhood?
Well, its stock had this massive run-up, over 50% in the month before the S&P 500 index rebalancing announcement. The index itself was only up about 7% in that time.
Whoa. So people were betting it would get added.
Precisely. And MarketWatch points to this study by some Harvard professors. They call it the disappearing index effect.
Yeah.
Meaning the market's gotten so efficient at pricing this stuff in before it happens. The actual bump a stock gets on the day it's announced for S&P 500 inclusion, it's plummeted. Used to be over 7% back in the 90s. Now it's less than 1% on average.
So all the action is beforehand.
Almost entirely. So when Robinhood wasn't added last Friday, shares tumbled initially on Monday. They recovered a bit later, but yeah.
So the takeaway for you, the listener, is...
The takeaway, as MarketWatch really underscores, is if you're thinking of trading on rumors of index inclusion, be aware. Most of that potential gain has probably already happened before the news even breaks. The big money is often made in the anticipation, not the actual announcement.
Good lesson. Okay, let's broaden out again. Any wider economic signals or risks catching your eye?
There was a thought-provoking piece in MarketWatch today. It suggested looking at the UK labor market data, maybe as a potential canary in the coal mine for the U.S. economy.
Oh, how so? The UK data was weak.
Yeah, pretty weak. The report showed UK unemployment rose to 4.6% highest in nearly 4 years, and payrolls fell quite a bit in May. And critically, this data actually triggers something called the SAM recession rule, for the UK anyway.
Remind me what that is again.
It's a rule designed for the U.S. technically. It signals a recession when the 3-month average unemployment rate rises 0.5 percentage point above its low over the previous 12 months.
And the UK just hit that threshold.
According to the data, yes. Now, it's important to contrast that with the U.S. Our labor market in May was cooling, sure, but not really deteriorating. Unemployment held steady at 4.2%. Payroll still rose.
So why the comparison then?
Because the two economies have similarities, right?
Yeah.
Heavily driven by consumers, by services. So seeing a significant weakening in a comparable developed economy, it's maybe something worth watching. Gives you clues about potential future trends, even if the direct impact isn't immediate.
Fair point. Differences too, though.
Oh, absolutely. MarketWatch points out the U.S. tech advantage, a stronger growth base, currently. But still, it's a data point. And interestingly, NVIDIA's CEO Jensen Huang was quoted in MarketWatch and CNBC talking about potential future UK investment once AI infrastructure is built. Highlights how crucial that AI piece is becoming globally.
Yeah, absolutely. Okay, now shifting gears quite dramatically into an area that's frankly pretty concerning, privacy and financial crime.
Yeah, some big stories here. CNBC reported a major development from the Justice Department. They've charged the founder of a U.S.-based crypto firm, a guy named Yuri Gunyan.
What are the charges?
Laundering over $500 million, mostly for sanctioned Russian entities.
Wow, half
Yeah.
a billion. How did he allegedly do it?
The details in the CNBC report are pretty specific. Allegedly used Tether, the dollar-pegged stablecoin,
Right.
doctored over 80 invoices, lied to banks and exchanges, used shell accounts, all to move money for sanctioned clients like big Russian banks, Sberbank, VTB, and even Rosatom, the state nuclear firm.
That's brazen. Any other allegations?
Yeah, the DOJ is also alleging ties to Russian intelligence officials in Iran, and even claims he helped export sensitive U.S. anti-terrorism-controlled tech to Russian clients.
Bad grief.
And the CNBC article included this little detail. He allegedly made Google searches like how to know if there's an investigation against you.
Oh boy, not subtle.
Not subtle at all. It's a really stark reminder of the illicit side of crypto. Potential sentence, if convicted, is huge bank fraud alone is up to 30 years.
Yikes. But it's not all dark news for stablecoins, is it?
No, interestingly, Reuters reported that Societe Generale, the big European bank, is actually launching its own dollar-backed stablecoin.
Really? A major bank.
Yep. It's called USD Coinvertible, expected to be publicly tradable soon on Ethereum and Solana. BNY Mellon is the custodian. It signals that major traditional finance players see legitimate uses here. Cross-border payments, collateral management, that kind of thing.
So mainstream adoption potentially picking up pace.
Could be. And just one more quick crypto-related point on security. The CNBC Daily Open mentioned the Bitcoin family.
Vaguely remember them, yeah.
They've reportedly had to completely overhaul their security, like hiding crypto codes on metal cards scattered across 4 continents, apparently due to recent crypto-related kidnappings.
Wow. That really highlights the physical security risks for people holding significant crypto, doesn't it?
It absolutely does. A very real concern, unfortunately.
Okay, moving to another major privacy concern highlighted in today's reports from MarketWatch and CNBC. This one involves government access to your data. The Supreme Court just ruled on something.
Yes, a ruling giving an entity called DOGE expanded access to highly sensitive Social Security Administration data.
DOGE, what is that, and why do they need SSA data?
Well, the context, according to these sources, is that the Trump administration set up DOGE, apparently, with members installed without normal vetting or training,
Yeah.
specifically to root out waste, fraud, and abuse within the SSA system.
Okay, but the data they get access to.
That's the alarming part. It's incredibly sensitive, personal stuff. MarketWatch and CNBC really spell it out. Your gender, immigration status, parents' names, their SSNs, your entire work history,
Wow.
private medical info if you applied for disability, bank account details, marriages, divorces, even potentially witness protection identities.
Yeah.
Basically everything the SSA knows about you.
That is a staggering amount of data. And the concerns are...
Concerns about this unfettered access are coming from multiple directions.
Yeah.
Supreme Court justices in dissent, like Justice Ketanji Brown Jackson, advocacy groups. MarketWatch quotes several experts expressing serious alarm.
Alarm about what specifically?
Well, partly about the risk of hacking, given alleged poor handling practices like accessing data from non-secure locations, but also, frankly, worry about what DOGE actually intends to do with all this information.
Could it be misused?
That's the fear. Experts quoted are concerned it could be weaponized. Imagine using gender at birth records against transgender people or citizenship status against immigrants, especially given some past actions MarketWatch noted, like the Trump administration canceling SSNs for certain immigrant workers.
And there's limited oversight.
Adding to the concern, yeah. A second Supreme Court ruling paused a requirement for DOGE to turn over documents under FOIA requests. So transparency about what they're actually doing is limited.
This sounds like a really big deal for personal privacy.
It feels like it. And in a related privacy battle, MarketWatch reported that several states, led by Oregon, are suing 23andMe in bankruptcy court.
The genetic testing company, why are they suing?
To try and block the sale of customers' personal genetic data without their explicit consent.
Ah, so as part of the bankruptcy, there's a risk the data gets sold off.
That's the concern. The states are arguing this kind of data, biological samples, DNA, health traits, medical records, is fundamentally different. It's too sensitive to be treated like, office furniture in a bankruptcy sale.
They're saying customers should control it.
Exactly. Even if a potential buyer, like Regeneron, who apparently wants the company, says they'll follow privacy policies, the states want to block any sale unless customers explicitly agree to it first.
Makes sense. So these are really crucial stories for you, the listener, regarding your personal information. The SSA ruling raises huge questions about government data security and control.
And the 23andMe case highlights the risks around your most sensitive biological data if you use those kinds of services. Things to be really aware of.
Definitely. Okay, let's circle back quickly to investment strategy. We talked about that emerging bullishness earlier, the high S&P targets, the melt-up talk.
Right. But as MarketWatch also highlighted, there's a counterpoint. Not everyone's buying into that bullish narrative.
Who's offering the counterview?
Strategists and MRB partners, for instance. They're actually recommending investors maintain an overweight exposure to cash right now.
Holding cash in this market. Why?
Their reasoning, according to the article, is pretty layered. They're worried about long-term bond yields potentially rising further.
Okay.
They think the market's too complacent about long-run inflation, especially the U.S. They see the U.S. economy as being late cycle.
Meaning closer to a downturn.
That's the implication.
Yeah.
And they just find U.S. equities expensive at current valuations. So they see limited upside for stocks because they expect rising yield will keep pressing down on those valuations.
Interesting. What's their take on the trade disputes we started with?
They apparently view them as more of an irritant than a major systemic risk, but acknowledge the unpredictability. They're also forecasting the dollar might weaken further and suggest maybe underweighting the U.S. slightly in portfolios, favoring places like the Eurozone, Japan, and emerging markets.
So you've got these two really different takes from credible strategists. One saying, buy stocks, potential melt up. The other saying, hold cash, risks are high. How do you process that?
It really just hammers home the importance of considering different perspectives, doesn't it? And understanding the reasoning behind each view before making your own decisions.
Absolutely. Okay, finally, one slightly different but maybe related point about risk. MarketWatch had an article touching on social media, something about Trump and Elon Musk.
Yeah, well, the specifics of their interactions aren't really our focus here. The article used it to make a broader, valuable point for pretty much everyone.
Which is?
Basically, be careful what you put out there on social media. Don't air grievances. Don't make imprudent comments because it can absolutely impact your professional life.
Hiring managers are looking.
Increasingly so. The article cited stats like 75% of hiring managers check social media profiles. They're looking at culture fit, red flags, professional engagement, all sorts of things. Your online persona matters.
And legal protections are limited.
Especially for private sector workers regarding things like political speech. Yeah. Protections vary by state, but generally less than for government employees. The article mentioned the Laramie Tunsil NFL draft story.
Yeah, the video that cost him millions.
Exactly. A stark reminder of real-world consequences.
So while it might seem a bit off topic from finance, that lesson from MarketWatch about managing your online presence, it's really about personal branding and risk management in today's world, isn't it?
Absolutely. What you put out there really does matter. Wow. Okay. That was quite a journey today. We covered a lot of ground.
We really did, from those global trade tensions and all the market moves across different continents.
To deep dives into really sensitive personal data privacy issues and that ongoing debate about investment strategy, bullish versus cautious.
It just highlights the complexity, doesn't it? And how interconnected everything is now. Think about it. International talks, corporate results, government data practices, even what we post online.
It all seems to feed into our financial world, our personal risks.
Exactly. How do we make sense of that interconnectedness, that rapid pace of change? It's definitely something worth mulling over as you process all of today's news.
Absolutely. And with that, I think we've covered today's major financial magazine headlines. Thanks for joining us for this deep dive.
Thanks, everyone.
And we'll see you all tomorrow morning with new headlines from major financial magazines.